Hey everyone, and welcome to this week's On the Spot, where we discuss what's going on in the freight markets. I'm Zach Strickland, Director of Freight Market Intelligence, and with me as always is John Paul Hampstead, Director of Passport Research. JP?
What's up, Zach? How's it going?
It's going. Another week, another active week in the freight market, and you know, I kind of wrote this piece last week about how imports were falling. You know, we saw this trend line declining, and I was thinking, okay, maybe this is the beginning of the end for this freight boom.
Right, because you would look for a signal upstream of trucking for, you know, a leading indicator of the slowdown. So something like import volumes, containers, you expect that to slow down before parcel.
Exactly, and again, it doesn't necessarily have to be imports connected directly to trucking or even rail, even though the rail and imports tend to be pretty hand in hand. Timing wise, you know, you can get stuff off the boat and it'll go into a warehouse and it can sit for months before it even, you know, makes the journey on the long haul trucking side. So, but this week, import volumes shot up again, like out of nowhere. We've had this long running trend line, and then all of a sudden, boom, we're back to where we were, you know, about mid-September or so. Any thoughts as to what's going on out there?
Yeah, this is another example of how you really have to, you know, understand the data sets, how they're constructed, what they're actually showing you, right? And so our import shipments data, right, really what it's really showing you is a count of bills of lading processed by customs officials. Now, there could be lots of different reasons why freight activity is strong, even though those counts may not be rising, right? Like, there's a limited number of people actually doing the physical processing.
Right.
In this case, there's a really big issue with just the throughput of the port itself, such that we've got, you know, more than a dozen vessels anchored off the coast, you know, in the San Pedro Bay, right? Off the coast of Long Beach, waiting to get in. And so, like, that tells you, you know, so when you have a situation like that, you get a divergence between, you know, organic or physical freight demand and the count of bills of lading.
Yeah, the bottlenecks, that's kind of been like the story of 2020 in the supply chain.
Sure.
The bottlenecks are everywhere. One of the biggest stories in the sector is the lack of containers. You know, they can't get enough containers. The container leasing companies are going haywire, producing.
Yeah, and that's actually caused issues inland too, right? So one of the reports that we've seen was kind of saying that the steamship lines and Asian shippers are pulling empty containers back to the ports, back across the Pacific Ocean, before American exporters have a chance to fill those containers.
Right.
And so now, like, you've got, you know, really high intermodal rejections in places like Chicago, even higher than LA, because the exporters don't have containers to load.
It's reminiscent of what we see in trucking with the food distribution centers. A lot of the carriers will actively avoid going into those spots when they're so busy because they have a lot of delays when they're getting loaded for food and stuff like that. And now we're seeing that on the container side for the agricultural exporters, and grain carloads blowing up. A lot of imports going over to, or exports going over to China because of a lot of reasons. But yeah, I think it's interesting to see that we're seeing a lot of the connectivity between the international and the domestic side really coming together this year as the supply chains start, like, they're trying to evolve or reemerge as something that can handle a lot more adaptation than they have in the past. So, you know, back to the surface side of things, the trucking markets, we're about to hit peak season.
Yeah, or we're in peak season.
Yeah,
right?
we're in peak season.
So outbound tender rejections on a national basis are above 27% for the second day in a row. Are we at all-time highs?
Yes, all-time high.
Okay, so
this week we actually hit an all-time high back in the early part of November for a hot second when we hit over 27% again, but it kind of faded for a minute, and then now we're back up.
And so again, you know, what that tells you is really just that we're off to the races, that carriers are the ones that have pricing power. They're the ones choosing which freight moves, and they're maximizing yield, right? It tells you that all, you know, what we heard from large brokers that starting in September is really when large shippers began to increase their contract rates,
Yep.
they haven't been able to drive routing guide compliance with those rate increases, right?
Yeah. No,
So,
I mean, when you're talking about in general rate increases on the contract side rarely go into the double digits. I mean, you have to have a significant reason to do that. And so contracts generally only increase about 3% maybe every year if you're lucky. But getting a 5% increase this year isn't going to be enough to cover like the spread between the spot market and the contract side.
Yeah.
So
that's right. And I mean, there are certain markets, you know, again, we have a lot of load board data in Sonar, which is really helpful, but it's really only a slice of the spot market,
right.
if you will, right? It's capacity of last resort. If you're handling large awards out of Southern California, for example,
right.
you're hopefully not posting all of those, you know, getting all those loads covered
right.
on either truck stop or DAT or something like that, right? Like,
yeah.
hopefully you have relationships, and so like, despite what the prices have done, I mean, people that move volume out of, you know, Southern California have basically just told me that like it's been $3 a mile, you know, since like June or July. Like
yeah.
that's it, and it's been, you know, so on DAT, on truck stop, it goes up and down, but it's like if you actually wanted to move and you want to keep doing business with these carriers, it's $3 a mile.
Yeah, and that's obviously like almost double the rate in a lot of spots that you would get on the contracted side. So it just doesn't make that you cannot adjust those contracts fast enough. And again, we've had this idea that we don't know how long this is going to persist
right.
into the future. Obviously, there's a lot of data that suggests that we're going to see, you know, elevated demand into 2021, which I think is pretty likely at this point.
I mean,
just
I
because
think,
of the backlogs.
Well, the backlogs, but I also think the coronavirus situation in the midterm is not getting better.
Right.
Right. So all of the things that have supported freight volumes, including you know, high grocery volumes, high retail of various kinds related to home goods
mm-hmm.
and CPG. Like, yeah, I would expect all of that to stay quite strong. And I just think that the coronavirus data is kind of telling us that like consumer behavior is not going to normalize away from freight toward things like, you know, hotels.
Yeah, no, we're talking about how e-commerce is going to blow up in November or for a peak season, but e-commerce is already blown up. So we're kind of seeing that expansion of what is a peak season that is pervaded throughout like September. I mean, tender rejection rates are at 27.4% right now. That's 1% higher than they were in September around Labor Day.
Right.
So this, you know, this idea that we've been in peak season.
Yeah,
is
yeah. Like I don't like. So the dynamics that we saw in September, right,
yeah.
and the heat in the market that we saw in September was not due to peak holiday retail shopping, right? And so
right.
I don't think that removing holiday retail shopping is going to cause cause demand to go off a cliff.
Right. The only difference now is, you know, around these holidays, we have drivers come off the road. It's more of a supply side issue than a demand side issue, but also the type of freight moving tends to have a little bit more service requirement around it as these retailers need to get things into the stores. Now, that's another good question is, are we going to see the expedited factor come into play this year? Because e-commerce, you know, when you order something online, it doesn't necessarily have to be right there in front of the consumer for you to be able to ship it. It needs to be in a warehouse in a DC, and obviously the prime users will expect their freight there. But will that lack of it needing to be physically present in a store for somebody to see this year make a difference?
It really depends on the retailer's omni-channel strategy or e-commerce strategy, right? So, for example, Target in their earnings call this week was talking about how they had actually fulfilled like, I want to say like 90% plus of their e-commerce sales from their brick and mortar locations. So they actually have, you know, fulfillment centers woven into the fabric of their physical stores.
Right.
And, you know, Walmart is kind of pulling that fulfillment function upstream a little bit, and they've talked, and it's been in the press, talked about doing pop-up fulfillment within their distribution centers, right? And so they're kind of removing that last leg of the truckload haul. You know what I'm saying?
Oh, yeah.
So like, it really just kind of depends on, what the retailer's approach to e-commerce is, and where in their supply chain it makes sense to fulfill those orders.
Yeah, I think it'll be interesting to see. I mean, we're obviously seeing increasing rejection rates already, but the fact that maybe these retailers don't necessarily need this freight to be right there in the consumer populations just yet. Now, what that may do in the future is, like we saw in March in the Northeast, huge amounts of short haul volumes, truckload volumes moving from these warehouses in upstate Pennsylvania, going into the megalopolises, New York City, Philadelphia, Washington, D.C., et cetera. And I think we're going to see a little bit more of that activity here in the next month or so.
Well, that's what's so interesting about e-commerce, is that it allows, in theory, right, if you have like really good data and you can pass data upstream really quickly, like you can match inventory to demand much more efficiently. And what do I mean by that? I mean that like, without e-commerce, you have to keep all of your stores stocked all the time. If I'm in Chattanooga, I'm going to the Chattanooga Walmart. If it doesn't have what I'm looking for, it won't be bought.
Right.
But with e-commerce, I can order something, on the store. If they don't have it in the Chattanooga location, maybe they can fulfill it from a Knoxville location.
Right.
Right. And so an e-commerce fulfillment center can actually fulfill orders from a wider geographic area, and maybe it makes the whole issue of like managing inventory a little bit simpler.
Yeah, I think it's interesting to see, especially when you get online. Now, there was a study done, I read this week, that said if you don't have the product that the consumer is looking for on your website available, you have a 50% shot of losing that customer forever. In terms of like, they won't come to your obviously it's not Amazon that they're doing this study on, because Amazon has just about everything. But, a lot of these sites, like if you go to just a random site that's not necessarily a huge,
like a direct-to-consumer site or something.
Yeah, exactly. Not like a Walmart or something like that. You have the chance of just not making that sale, and that's what retailers are scared of most of the time. I mean, these brick and mortar traditional Macy's, Nordstrom's, places like that don't have a huge online presence, like in relation to like an Amazon.
Right.
They need to make sure that they have availability. So I think that will have at least some impact on how they handle this situation. What it does to the expedited freight and that service time-sensitive retail freight that really drives prices up even higher this time of year, I think we will see a little bit of a pullback on that, other than just what's already there, which is this huge backlog of freight.
Yeah, that makes sense. That makes sense to me. So where do you see spot rates going in the next couple weeks?
I mean, they're going up. they're going up. Now, the question is, how much are they going to go up? We're already over $3 a mile, like you said, in a lot of markets, a lot of lanes that are traditionally under $2 a mile. They'll go up a little bit more. I think we're going to see tender rejection rates break that 30% boundary here over the next month or so. I feel like this is the time for that. And
that's
again,
just mayhem. That's just pandemonium.
I mean, what that means for spot rates is it probably means another 5 to 10% jump in some of those lanes.
And it also just means a kind of a thoroughgoing reshuffling of relationships between shippers and 3PLs, right? Like, there's going to be lots of opportunities for people who can step up and provide service, and I think people who have a more short-term view of their relationships might get punished.
Yeah, I mean, if you're a broker in this market, you're padding your margins every week. You were at $3.02 last week, go up to $3.04 this week. And you're padding your margins if you don't have that coverage. If you're a carrier, you're probably diverting a little bit more capacity to the spot market.
Yeah, interesting. Well, thanks for that. I agree that I think things will go higher, but not a 50% jump or a 75% jump. Things are already exceptionally hot.
Exactly. So time will tell. We're about to jump into it next week. Lead times actually fell last week as tender rejection rates go up. So these shippers do have a sense of urgency about them, and that will drive rates up even further. And that'll do it for this week's On the Spot. Make sure to check us out on FreightWaves TV. If you don't have the app already downloaded, download that, and check us out on Freightcast for any podcast subscribers. Have a great week.